Hello and welcome to another episode of the Financial Pro podcast. Today we've got a superb interview for you with Rory from JLM, which funnily enough used to be my manager back in Connells back in 2003, 2004 kind of time. Once you get in this industry, you can't get out, and it's such a small place. But to give you a bit of history on Rory, he's actually the owner of 5 businesses, having a bit of a LinkedIn stalk on his, but it's in a vast area of financial services, from being a network owner, being in wealth management, being in equity release, being in fintech, even being in sports management, it would seem as well. But JLM have actually won Best Network for ARs under 300 people in 2019, and a multitude of other awards as well. So we were just having a conversation before, and there's going to be loads of education and inspiration for everybody within financial services, not just mortgage advisors. So Rory, good morning, sir.
Morning, Gary.
How you doing? You okay?
Yeah, no, very well. I was just thinking how very little you changed over the 16 years or so since we last spent a lot of time together, whereas alas, I'm looking extremely old and haggard, but there you go. Good genes, I guess.
It's the quarter Indian blood that I have within me.
I'm half Indian, and it doesn't seem to be doing me so much good, but there you have it.
Yeah, but the good thing that I've dropped is a lot of the fake tan and the bad hair highlights that I used to have back then. Hey,
those were the days, my friend. Yes.
I've actually still got one of the kind of corporate image photos of me where I'm in the white shirt with the blue chunky tie, where I've obviously selfied in the office. I was just like, oh my God, it's one of those cringeworthy ones you don't want to look back on.
Absolutely.
But maybe you're looking good from this side of the camera anyway, mate, so don't you worry about that. But running 5 businesses, could that, that's got to be a hard feast, has it not?
Yeah, I mean, I was saying briefly when we spoke beforehand, we're a bit of a strange organisation, really, purely and simply because our aspirations were never to do where we are today. So I think when we worked together, we both went off and did our own thing. Myself and one of my former colleagues, Seb Murphy, set up JLM, and we set it up really as a DA mortgage brokerage, just to kind of do the right thing. We thought we'll come from a place where we want to be fully independent. We want to offer transparent advice, transparent fee structure, and kind of do the right thing by everybody. And then it's accidentally, over the intervening, 15 years, morphed into something bigger. So the various other businesses, apart from the sports thing, which is a kind of is rather different, but most of them have morphed out the fact that we've sought out somebody, for example, to offer wealth management advice, and struggled to find somebody who wants to look after our clients, because most of our clients have mortgages. They're often quite well paid, but they're at a life stage where they perhaps don't have millions in the bank, but are good earners, but have mortgages. And we couldn't find anyone who wanted to service them in the way that we felt comfortable with them being serviced, or and that kind of thing. Likewise, equity release, it's changed much for the good over the last few years, but it was a business where everyone wanted to charge you a 2% fee and possibly didn't offer whole of market access, and also would only talk about equity release, whereas we felt things should be looked at holistically. So we thought, you know what, we'll do it ourselves. The downside is it's meant I've had to do huge numbers of additional qualifications, but that aside, it's been good, and it does mean that I can feel confident that anyone who comes to talk to us will hopefully be given advice fully in the round, which I think is good.
Definitely, and vital as well, I think, in this lovely compliance world that we are now in. Before we get deeper into what you've just been speaking about there, and we were having a great conversation before we kind of went live on this as well, take us back to pre-Connells, maybe before you got into financial services, or estate agencies kind of linked, and then give us a little bit of a journey up to now to give people some context.
Yeah, so my life has been a series of accidents, really. So it's maybe not a very positive way to start. So I did a degree in English language and literature, and I was from the generation where very few people did degrees. So I kind of thought, well, if I get a degree, then that makes me, really special and super employable. So I decided to do English Lit because I enjoyed reading. And then I decided to have a kind of a fairly heavy specialisation on Anglo-Saxon because I thought it'd be interesting. Then erupting at 21 onto the job market, I suddenly discovered that actually fewer people than you might imagine. I mean, obviously in hindsight, it was obvious. Wanted to employ somebody with my slightly peculiar set of skills. So I floated around for a bit. I got a job in the city briefly, and then unfortunately the firm I worked for went bust as I was buying a flat through a little estate agent you mentioned earlier, Connells. So I wandered into Connells and said, I'm ever so sorry, I've lost my job. I'm probably going to have to withdraw from the purchase. And they said, well, actually, you've just exchanged contracts, which means you can't. Have you ever thought about being an estate agent? So I said, well, no, not really. And they said, well, do you want to think about being an estate agent? And at that point in time, I didn't have a job and I obviously had just bought a flat. So I said, yes. So I was a very, very unskilled estate agent for a matter of a few weeks, had very little sense of direction, which is not a good characteristic in an estate agent. Left a few weeks later, I think by mutual consent, haven't gotten very well, and went and joined Ensley Insurance, who at the time were, what was then Friends Provident reps. Did my FS exams and got a call from my old boss at Connells saying, we're sorry to see you go, but obviously the estate agency wasn't a good fit for you. Would you consider coming back as a mortgage advisor? We understand you've just finished your qualifications. And the office was in Bedford. At the time I was living in Bedford, and for a Friends Provident job was in Slough, which is rather inconvenient from Bedford. So I said yes. And that was in about 1994. And I haven't yet managed to escape. So that is how I got into the mortgage industry. So yeah, completely by accident, but I have to say, well, I'm still here. It's fantastic. I think it's one of the most underrated industries there is. If you're an ambitious kid getting good results, you think, well, I'd like to go into the city, there's a good career there. And I actually think that the mortgage industry has hugely undersold itself over the years, because I think, a good advisor can get a huge amount of job satisfaction, generally help people, and also get paid extremely well if they do their job well. There's not that many jobs which allow you to do that. Flexible working. Here I am sat effectively at home, yet still productive. It's fantastic.
Yeah. So your business, JLM, effectively started back in 2005, roughly.
Yeah, that's right. Seb left first and started up the business, so he's kind of the true founder. But I came on board a couple of years later. We were good friends, with a view to kind of helping him take it, I guess, somewhere further. And obviously, it's gone a wee bit further than perhaps either of us anticipated. But that's no bad thing.
Yeah. So you joined 2005.
Yeah.
And what was kind of your first few years like leading up to, say, Credit Crunch? Were you a network at that point, or were you actually just a brokerage?
Yeah, so we were literally just a brokerage. So I started off, it was a bit of kind of back to the shop floor. I mean, obviously, when you and I worked together, I had a traditional kind of, I guess, sales management role. I think I had a slightly more glorious title, but basically driving around, drinking coffee and being motivational was kind of my stock in trade. And it was kind of back to sitting in front of clients. Obviously, I didn't have any clients, so I was based out of an estate agency for a few years. And doing that, and it went pretty well. It was a very different market kind of pre-crunch. There were lots of new lenders out there. There were some kind of slightly weird and wonderful products, which at the time were great. In hindsight, perhaps may have not been the wisest bits of lending. Let's mention self-cert as an example. But it was an interesting market, and it was a good time to get established. And I was kind of I think I had a very, very young family through that period, and it was good. I think it was a nice place to be. We had a few advisors join us, and actually the Credit Crunch is effectively what spawned the network. So I think I always remember in Christmas 2007, I think it was, I was sitting in a ski resort in Meribel, realising that I hadn't been able to pay myself for the previous 4 months, but this was a holiday I'd booked back in the spring with 2 children under 3, thinking, this is looking a bit iffy. So we reinvented ourselves. We spoke to the advisors who we had as employees at that point in time and said, well, shall we think about changing our relationship so effectively you become appointed representatives? That way you've got more independence, you've got more freedom, and we don't have the responsibility of having to find you leads and a salary every month. We got very heavily at that point into the various governmental shared assistance schemes, particularly shared ownership. So some way away from where we specialise today. And yeah, that kind of accidentally turned us into a network, because suddenly from coming as a small brokerage with a couple of employees, we, by the end, I guess, of 2009, and we can probably check the figures, but we turned into a smallish brokerage with quite a lot of support staff, our own compliance person, and 3 or 4 appointed representative firms. And I'm pleased to say that pretty much, yeah, I think all of them are still with us today. So it's, you know, we've all travelled through the journey together, and that's been nice.
Yeah, amazing. And it's great to have that kind of kickoff. And you're right in the sense of it's kind of the same ethos that I'm at now in the stage of where I'm at in my business. It's like I had a decision a couple of years ago. Do I go and recruit a load of employees? Well, actually, my niche as a brokerage is self-employed. Love working with self-employed business owners, love the mindset. Let's kind of just get some, you know, what is now nearly 10 self-employed advisors and help them, support them. But one thing I'm interested in there that you really mentioned, which I think is quite interesting for others as well, is you said that you brought in that compliance person. You know, so going from an employed model where you were a small brokerage to then going to be effectively a network with a few ARs.
Yeah.
How did you kind of manage that thought around the FCA compliance rules, the changes of having ARs versus having employees? Because there is a difference under the FCA rules, isn't there?
Absolutely. And it's something the FCA obviously clocked, because they came and visited us to have a look at our systems a few, you know, not many years down the line from there. So I think we had always had administrators. So I think our previous model, and you'll remember this from Connell's, is a model very much was to try and have advisors doing advice stuff and having support staff doing all the stuff around them to allow the advisor to be more productive and actually do effectively what they were trained to do, rather than spend ages making phone calls to lenders and sitting on hold to X for an hour and a half. So we'd done that. We then thought, well, we're getting a bit bigger, and because these guys are becoming appointed representatives, whilst we know them very well, more people may come along, and also we need to have a better handle on what they're doing, and we need to be able to guide them in a slightly different way. You know as well as I do that if you work for somebody, they say you need to fill this sheet in this way, and you might disagree, but after very quietly mentioning your slight disagreement in a tactful way, you basically just get on with it and either feel resentful and think about a new job, or you just crack on. Whereas where you've got people who are appointed reps, obviously the whole basis of that is they're running their own businesses, they've got their own brand, they've got their own niche, and they've probably got some slight differences in sales process. And obviously those will diverge the longer they're appointed representatives and the more they get into whatever market they're in. So one of our first ARs is hugely active in the shared ownership market. That wasn't our traditional market. We got into it and it sorts very well through the credit crunch, and actually it's a really nice market to be in. But obviously his processes evolved based upon that market, based upon having to do those, you know, initial phone calls and make sure that people fitted them, the affordability and fitted the HCA's requirements. Whereas that wasn't part of our model. So having an in-house compliance person meant that we were able to say, well, okay, we're not going to come up with the script, but let's come up with a checklist for you in this market that suits your market and suits your process, which might be slightly different from a checklist we have for person B who looks after a different market. And that was the rationale. And actually that's been something we've had ever since, because it is a really successful and good way of running a business, because this mortgages, even more so now when you've got the various hassles of lenders struggling with capacity and COVID and things, it's incredibly process led. So what you need is specific processes for people working in a specific way in specific markets. We'd have a different compliance process for somebody sitting in an estate agency office doing what both you and I were doing, you know, 15, 20 years ago, from somebody who was buying in leads, working at home and doing things remotely. So it's important to have a compliance I guess, enough compliance support to be able to create those structures for those people, because then everyone does things in the right way. And also you could say, if that was, you could say in the self-employed market, Rory, what you're asking for makes no sense, because actually for my people, most of my guys we're doing lending based on, let's say, retained profit in a business. So you saying that what I need is tax year overviews and tax calc, I understand the rationale, but actually for my business, really probably their accounts are very important. Or I've got a standard accountant's reference that I want to get created. On the flip side, if we were dealing in the kind of high net worth private banking space, you say, Rory, your proof of research doesn't mean anything to me, because I'm going out and getting bespoke head of terms from lenders whose rates are a good 0.5% to 1% more, but they can't go anywhere else. So what's the point in you asking me for my Trigold proof of research, because the products aren't on Trigold and it's irrelevant. So what we've been able to do therefore is start coming up with something where we can bespoke our regime to each person's business model.
That is really, really refreshing to hear. And it's not something I've ever heard. In 2018, my thought process, I've been directly authorized since 2009. So 2018 for me, I restructured my entire brokerage, and there was an element of, which CRM system do I use? Yeah. Because like you said, process is absolutely key, and systems is what the FCA came in to look at your business around. And I'm a massive advocate of automation and speed. Yeah. But equally, it's like, God, I want to start recruiting advisors now. I've got too many leads. But actually being directly authorized with me, my admin and my marketing person, I don't want to get bogged down dealing with files. I don't want to get bogged down with, the check-in that you have to do as a DA organization. So I actually set up a separate limited company in 2016 underneath Primus, and you didn't come into my radar then. I know the owner of Mortgages First in Colchester.
Yeah.
So we played golf together, or you might know it as Elms Price Maston actually. Yeah. So I could play golf with Steve since I was kind of 15, although I don't play anymore. And he put me in through Primus because that's who they're with, and it was just that element of, actually I realised the specialist market that we deal in. Although I flew through compliance and all of that, Mortgage Pro came around at that point in time, I realized that actually, DA Life suited my business model better. But that's vital in terms of how do you manage and this is kind of just, I'm intrigued from a business perspective, giving everybody the freedom and autonomy to a degree to be able to have their own compliance process based on their niche or their business model. Now, surely that's got to be way more admin orientated, way more time consuming than, say, every other network that I've seen to speak to has one process, one set of documents, one file check method. Does that make sense?
Yeah, absolutely. And I mean, I think it's why it's why we are quite fussy about who we take on, because effectively it needs to be commercial, right? So as just as a side, so we had some guys join us recently. They deal mainly in prime development, London and internationally. So Monaco, the normal places you would expect. A lot of their buyers are international. A lot of their lending sources are international. There's a huge amount of additional complexity. We have family offices involved, with private banks. We have all kinds of weird and wonderful things. And so as a result, they needed a bespoke process, but we were confident that their income, I think that the biggest deal they've done this year was worth about £320,000 in commission. So from our perspective, that justifies us saying, well, we will give you a bespoke compliance offering to allow this stuff to fit in. Whereas, and those really are the kind of people we're interested in. We're interested. We don't necessarily, we're not precious. We're not saying, oh, well, we're terribly high net worth and very London and super special, because we have got a firm who still, one of the ones I mentioned before, they do mainly shared ownership and they're very, very good at it. But there's a few advisors in that firm, they're very successful, and their income's really high because they do their job very well. And also shared ownership, in a very different way, is a lovely market to look at because there's good protection opportunities. Do you protect just the mortgage? Should you protect the other part of the share? You're often dealing with younger people. They might have families. There's lots of other conversations that come off those things, just as there are, but actually they consequently need a slightly different compliance approach, because we need to be looking at not only the lender's affordability and our internal affordability, but obviously what they're allowed to do by whoever the other stakeholder is. So the answer is yes, it is much more expensive. So, people wouldn't come to us because they'd say, well, I've been shopping around and these people have offered me 8% and these have offered me 9%, and what can you guys do? And I'd say, well, we're going to be more expensive than that, or we're going to demand that you have a very high income, but we can come up with something. So traditionally, people have joined us from a lot of, I guess, the kind of the prime brokerages, the SPFs and the Ennises and so on and so forth, because we're good in that market and we understand that they may need something that you couldn't get. And we've had a lot of people join us from some of the big networks. And the big networks, don't get me wrong, if you're a new mortgage broker starting up and I'd say out of every 4 or 5 people we speak to, we probably say to 80 odd, maybe 90% of them, we're not the right home for you, but have a chat with these guys, because there's some very good networks in this industry, but most of them, as you rightly say, are looking just for mortgage advisors, good mortgage advisors, but they're not looking for niche advisors, and we very much are. We're not precious about the niche. There's some things we're not particularly good at, so we're not very good at adverse, for example, so that's probably not a niche for us. There's some very good brokerages that do that, but it's not our thing. We're pretty good at online stuff, so we've had a couple of robo advice firms working under our network. Why they're working under us? Because we're good at understanding their process and coming up with a compliance solution for them, and also we're fairly tech friendly. So that's worked quite well. But yes, and distribution's the other reason you go to a network, okay? So if you're a very good DA firm, and people say this to me quite often, I'm a really good DA firm, we've got 5 advisors, we're doing well, why on earth would we talk to you as a network? And I said, well, A, we can come up with something that's fairly bespoke. B, as a business principle, how many hours a week do you spend filling in an RMAR or going on to Gabriel or talking to the FCA or checking files, and we can do all that stuff for you. So let's work out a cost for that. But finally, there's some lenders who you just simply won't have access to. Some of them are kind of limited panel, like Clydesdale are probably the classic example, who tend to be a bit weird about panel. We'll see if that changes with the Virgin Money influence, or Ipswich, Cambridge. Some of these are quite limited distribution. And in our world, it's people like EFG over in Guernsey, or Hawes, or Climeworks, or Hambros. Oops, sorry. Now that is a disadvantage of remote working, isn't it? As your office
the reality.
Yeah, a bit of void coming in. But yeah, so I think that's primarily what we do, and also what we do. And again, I think it's unique. I've often thought of most networks, without being in any way negative about them, it's how their model works. But most networks, I tend to think as double dippers, and I take that from a man who's got fairly young kids, right? So one shouldn't double dip in life, generally speaking, right? If you put that Dorito in your mouth, it should stay in your mouth and not go back into the dip. And in the same way, I think many networks will say, we get paid 0.35 by NatWest and we'll pay you 0.34. Actually, NatWest are paying them 0.4, and they're just keeping that extra bit as a network override. But my view is, when we started off, we said we're transparent. So if we say we're going to charge you 20%, it'll be 20% of the gross we get paid, not the net gross we get paid. So consequently, we quite often find that we pay advisors to come across to us, not a huge amounts, but maybe an extra 20% on some lenders' procuration fees. Well, if their broker fee is also, if their network fee is 15 or 20%, actually for those lenders, we're entirely free of charge. So it's not a hugely complicated model, but it's a very straightforward model. Loaded life commissions will be another thing, loaded life premiums. We've never done that. I understand the business rationale for it. It's not our rationale, because that's not kind of where we sit. So there's lots of ways we do things which work for advisors, but the whole idea, as I said when we first started, we said, let's be nice and transparent, and that was the rationale. Yeah,
it's good to have that honesty and that integrity, because I think there's some models that I looked at in 2015 or 2018. Sorry, I was almost felt like I needed to go back to school and get a maths degree in order to be able to understand how the splits were working. And it was like, this is just, keep it simple, for Christ's sake. And it's just,
Absolutely.
I think it makes it so much easier for advisors to understand and make better decisions at the end of the day.
Yeah. Well, you and I both know that in corporate world, often you'll have a commission structure which is so complicated it's almost incomprehensible. You have a really good year and are quite excited. You're told, fantastic news, we're changing our structure for next year. But it's so immensely complicated that unless you've got that kind of background in whatever it is, nuclear physics, or you're Stephen Hawkins, you can't actually work out whether you're worse off or better off. And the cynic in you says, I bet I'm going to be worse off. But it's very difficult to prove. So when people join us, we say we take X% off all income. So we don't care what sort of income it is. We'll just take a slice of it. And that's it. And then it's very linear. It's very transparent. People know what they're getting. And then that way, if we're able to persuade a lender to slightly enhance their procuration fees, or we're able to persuade a protection provider because we've gone over a certain limit that we can get a bit more on protection, fantastic. Everyone shares that because they know that they get, let's say, 80% of the gain. And I think that's a nice, fair way of doing business. And I think it's probably one of the reasons why we've lost very few people over the years.
Yeah, I would agree with that without a shadow of a doubt. So I think a good question that's sort of rolling around in my head then is in your opinion, what is the role of a network in this industry?
It's a good question, and most people I know who are DA will come to me and say, what's the point of a network apart from stripping some of our income off? And I think it's two or threefold. So I mean, I'll give you a couple of examples. So we've had somebody recently who joined us, and then after they joined us, we got notified by a lender that they actually were removing them from panel because of what went on at their previous network. We had a jolly good look at it. We were very happy if the person wasn't complicit in any way, and we felt that to a certain extent, had their previous home done a few more checks a bit earlier on in the process, rather than most networks check files when they're kind of dead and buried and paid up and gone, it would have been spotted. So we went back to the lender, we gave them an idea of an enhanced compliance regime that we would impose for a 6-month period, and we agreed with them that after that we'd share the data with them, and if they were happy with the quality, they would reinstate, and we got them reinstated. So that's one very obvious example. Now, I'm not saying every network doesn't do that, but again, it was a very nice open conversation between all parties, and we've won quite a few business quality awards, Legal & General a few times, and various other people. So I think as a business, we're generally seen as being pretty compliant and pretty good about what we do. And again, that's that transparency thing again. So I think that's number one. Number two is distribution, which I think I've talked about already. And I suppose number three is purely simply letting advisors focus on advising. I said earlier about taking, one of our first steps was to employ someone in compliance, as well as support. Advisors are highly, highly skilled people. I've never, looking at it from a simplistic perspective, if I had two people working for me, if I ran a plumbing business and I had one person who was a plumber and someone else who was an apprentice, I would not get the plumber to be carrying pipes from the van into the house if the apprentice was also there. It makes no sense. And again, in mortgage world, you should let each person do what they're very good at. Many mortgage advisors, aren't terribly good at admin. They're probably better than they once were, but they're not terribly good at it because they tend to be salespeople, and salespeople are very nice about good at talking to customers and explaining complicated things simply, but somehow they don't tend to be very good at paperwork. Probably rather better than they used to be, but not that great. So why not let somebody else take hold of that side of things? What does the regulator think? The regulator thinks that the advisor should be giving the advice. The regulator doesn't have a strong opinion on who produces the mortgage illustrations. Yeah, with many lenders, they're happy for an administrator to submit the application because the advice has been given by someone authorised, and the other bit's seen as an admin task. Going into where we're going now with, the likes of Lendex and Mortgage Apply and lots of straight-through systems, we've got a virtual advisor system ourselves, which is probably, has elements of a Habito model about it. Actually, the important bit in that section is the advice bit. All the rest is administration. So you don't need to have, frankly, a highly trained and highly expensive person doing that bit of the job. It doesn't make any sense. So that's what we try to do as a network. So you mentioned earlier, if we have an advisor join us and then suddenly say, I'm getting a bit busy, but can I justify 18, 20, 25, whatever it may be, cost of getting a good experienced administrator? We'll say, well, fine, we've got some spare capacity. You can effectively share one of our admins, and if you're taking 25% of their capacity, you pay them 25% of their salary. We don't make money out of it, but it's a very easy, cheap way of people getting extra support. And that's the kind of thing that I think a network should be able to do. We are weird, I've said that before, because we're a hybrid. So we're both a DA mortgage brokerage and a network, but that means consequently we can offer both bits. So we as a network can offer you a locum advisor if, you know, we've got someone off sick who's COVID positive at the moment. Happily, they're not terribly well, but obviously they're mainly spending their days sleeping. We're able to just drop a locum in for them, and they know that their business will carry on as if they were still there. And that's the kind of thing a good network should be doing, in my opinion. And often, if you're a one-man band DA firm, you're going to struggle with that.
Yeah, most definitely. And out of interest, what is the sort of ratio? I think you said prior to this, you've got about 125 on the entire team. What's the ratio? What's your employed model, and then what's your own brokerage model, and then what's the size of your network model?
The majority is in the AR business. That didn't used to be the case, but that size of things has grown, and it's grown also quite organically because good AR firms tend to take on new advisors. You know yourself. So I think now we're probably we've got, I couldn't tell you exactly, but probably 15 or something of the advisors. So I'd say very simply, we've probably got 15 advisors within JLM itself. We've probably got another 85 within AR firms, and then we've got a few more people in the process of being recruited. What's interesting is out of that number, we've probably then got nearly half as many people, so I don't know, somewhere between 40 and 50 on the support and admin side. You know, our most successful brokers have pretty much got a Model T Ford process where they'll do something, then it'll go to a pre-application administrator, then it'll go to them for the advice, then it'll go to a post-application administrator, and then it'll go back to them at the end to look at protection or just do a, you know, congratulations, look forward to speaking to you in 4.5 years call. And that's a very efficient way for brokerages to work. I think one of the other things we found with a lot of our advisors is a lot of them are very happy being one-man bands. So I've spoken about AR firms, and many of our ARs are in very high-performing individuals, and they've tried taking on additional advisors historically. And I'm sure you've been through this journey. I know I have. Your first 2 or 3 advisors quite often cause you more headaches than you can possibly imagine, and actually take up far more of your time. So actually you look at it and you think, well, from a purely commercial perspective, if I'm a good advisor and I can write £200,000 worth of business this year, actually, I'm not having to dedicate half of my time to looking after 3 advisors, and my override from them is not the 100,000 I'm now giving up. Does it make commercial sense to do this? And I think that's a journey every advisor who's good goes on, because you realize you can't do things, perhaps it's hard to get someone else to do things as well as you think they should be done. And and you know, so for us, again, for those people, they need actually a lot more support on the resource side of things.
Without a doubt. And that's something, actually, I want to reiterate that point that you've just perfectly made, because this is something that I really, really preach within Mortgage Pro, within coaching my mentees, you know, 150 online mentees, and coaching clients that I work with one-to-one. It's like, you've got 2 choices. If you're a one-person army, your thought process is, I've got too many leads. Let me go and take on 2 or 3 advisors, because I can leverage those leads over there, which actually I can earn a little bit of that. I can still do some of my own stuff. But actually taking on 2, 3, even 1 advisor, you need to manage them. You need to monitor them. You need to make sure they're looking after the leads in the same way that you are. And if they don't convert in the same way that you do, you're just hindering your own income. So on the other side of the coin, like you just said as well, the thing that I say is, if you're going to be DA, or if you're going to, your first recruit must be a PA or an administrator. Yes, because exactly as you said. And then after that, it's a case of, before you take on another advisor, exactly as you said, then your high performing businesses have a paraplanner, shall we say, a pre-application support. Then they've got a post-application support. And even I'm actually a fan of having someone to help you with the marketing in the social media world that we now live on before you even take on your first advisor. Maybe one of your paraplanners or your administrators in that first employee is actually a trainee who's going through CMAP, who, starts as your admin, becomes your paraplanner, and you stick an admin in, and, you follow that just consistent model, and you'll grow organically, but you'll do it in a stress-free way without massively hindering your income. And you'll have the team there to enable you to then monitor the advisor that you come in to make sure that they hit the first phone call the best they can. They sell the fee in the best way. They're working efficiently. You're monitoring their conversions and so on and so forth. And I'm so glad to hear you say that's what you're seeing, because I want to drum that home for everybody listening to this, that it is the way to do it.
Absolutely, Gary. And and what you've got then is you've got a proper support network. And I think many advisors, you and I both know most advisors, I'm being slightly rude about them in terms of admin, and that's maybe a bit old fashioned, but also they don't often, they're not always managers. Advisors tend to be cut from a certain type of cloth, and it's quite often not management cloth. So consequently, why buy yourself an entirely extra role? Do you remember back in the day, we used to have, back at Connells, they had lots of advisors trying to do a hybrid manager advisor role, and generally they got promoted or demoted out of that role very quickly, because it was almost impossible to do. Because if you're being paid income for selling a mortgage, and you've got somebody else who you're looking after, where you might get an income 6 months down the line once you've trained them up and they've started writing business, you're probably going to prioritize your own sales over that. Whereas, which isn't what you need. So I completely agree. I also think that, in my experience, our highest performing individual advisors have all tried taking on other advisors, have all decided not, have tried that, it didn't work, and haven't done so, and have now very much going with, your model of multiple support people. And I actually think most advisors, whilst it sounds lovely to say, oh, I've got this enormous advisor firm and all these people working for me, actually for most advisors, they're much better off sticking with their day job and not trying to be something else, because they're very, very good at their day job. So don't compromise it.
Definitely agree with you in that sense as well. It's my journey of business has been very much trial and error in multitude of different ways. And as you say, management is, I do a lot of managing because you have to, but it's not my day-to-day skill in that point. And it's, I'm much more of a bigger picture thinker, constantly, whereas you need to be more of an in the now kind of thinker to be a manager. And when we recruited February this year, pre-COVID, I took on 5 advisors in one fell swoop. Wow. Needless to say, Andrew, who joined me in August 2019, used to be a branch manager at Halifax for 12 years. He's been through the Sainsbury's management scheme. And when the advisors joined at the beginning of February, I realized how much time of mine that was taking. By the 17th of March, he moved into my operations manager role. I even remember the day. It's like that, it's that point. Yeah. It's just like, oh.
Yeah, absolutely. Let people do what they're good at. And certainly, I think the other thing I think useful sharing, and I don't know whether other firms do this, we have been really successful on the support side of things, specializing in flexible working. So an awful lot of people in support roles for us are often part-time working women. We don't dictate their hours to them. They some will come into the office, some work from home, because what I've realized, I've got 4 kids. So, my poor wife is a kind of a logistical master. I know, madness. Eh?
What did you do that for? I'm stopping at 3. The wife's saying to me, come on, let's just have one more. Hunter's only 3.
Even numbers. Yeah, I don't know. I've got a thing about even numbers, but anyway, let's, 5 is crazy and 6 is. Anyway, so what I found out is, anyone, whether a stay-at-home dad or mum, but most of ours are mums, they are logistical geniuses, okay? They have to juggle so many things. So actually just plonking a job into there as well is great, but don't dictate hours, because the nature, again, of being a parent is you do have to suddenly breeze off to this. You have this commitment, you have to do this, or someone's ill. So actually what we do is we employ people typically on weekly contracts and say, on permanent contracts, but on a weekly hours, say, get them in when you can. And if there's 8 people and we need cover between these times, kind of to a degree work out between you, because you're going to be way, way better doing that than we are, and you do it successfully. And actually what we've tended to find is having that approach has given us such fantastic members of staff, because what they wanted was the flexibility to allow something that worked around, you know, their other commitments. And from our perspective, we get really, really, really good people, and we pay them well, but we don't perhaps pay them as much as if we had to take in someone full-time and steal them from another broker who's doing the same job, because we can train a lot of skills, and they've got a lot of them innately. And from our perspective, we've got amazing flexible workers who are incredibly invested in the business. And, you know, and many of those have then gone on to become full-time employed. You know, our management team pretty much is entirely made up by people who joined us on that basis initially, because they know us inside out. They know our culture. They know how we work. So they're amazing employees. And then again, let them do what they're good at. So if you've got someone who's very interested in social media, knows how it works, and is interested in marketing, obviously that should be a role that you let them grow into.
Yeah, definitely. It keeps it interesting, isn't it? One of the things I kind of realized, partly in my own journey, but something recently, is generally people need to change their role roughly every 2 years.
Okay, that's interesting.
To keep the same kind of energy level and excitement. You know, when there's so many new things that we learn, and particularly as children, we learn constantly all the time. And I'm guilty of this in my early adulthood, with just plateauing out, and actually learning and developing, improving and growing is what keeps the spark lit in some respects. And that's, by the sounds of it, the freedom, the autonomy, the development opportunities within JLM is what's kept people with you for such a long period of time. Absolutely.
And, you know, we did a lot of this in equity release. So we went to all our advisors and said, would anyone be interested in becoming dual qualified? And if that's of interest, let's us support you through it. And let the other members of the network, because the other difference about us, I think, is we try not to compete with one another. We're trying to maintain as much as one can, when basically we're a whole host of competing businesses. We try to operate in quite a family type way. So most of our equity release leads, for example, are generated internally by advisors who don't have the qualification, passing it over to advisors who do have a qualification. We've got a whole protection department who do protection for advisors, and they tend to do it in two scenarios: A, when the originating advisor is too busy to do it themselves, and B, when the originating advisor realizes that someone needs a more complex and saying, here's a joint term policy, thanks very much. And they want to have a conversation with somebody who wants to talk about key man, partnership protection, share protection, you know, various other bits and pieces. And again, we can bring skills to do that, but we'll do pretty much a straight down the middle fee split on it. So we try to operate very much in that way.
Yeah, so you mentioned there the importance of protection, and I think this is a great segue into that from the point of view. I'm a massive fan of it. I'm a big advocate. I did an insurance business for nigh on 7 years. You know, we always sold over the phone as well, so that's not been a problem for us during the lockdown. But often the difficulty for people coming into the mortgage industry is it's all based on transaction of a mortgage, and particularly in the time now where research is taking 5 times longer than it did before because of the issues that lenders are having, you know, constantly pulling products, and it's like 90% is like a light switch. It's here one moment and gone the next. And, you know, you mentioned the importance of protection there. At what point do you think a mortgage advisor should look to leverage out the protection? Because it is its own specialism. 18 lenders, multiple medical history issues, you know, all those considerations.
It is. I mean, one of my frustrations, you know, back in a previous life, I used to say mortgage advisors tend to operate in an odd way, because historically, I mean, many still do, we give out a CIDD disclosing that we're going to look at mortgages and protection. And I say, often it's a bit like going to a restaurant where they give you a menu and a wine list, and then refuse to discuss the wine list with you at any point at all, and just make you order food. And obviously go to a restaurant because you're hungry, but you might want to drink as well. So, you know, without wanting to stretch the analogy to breaking point, I think the way we were trained back in the day, and bear in mind that I'm so incredibly old that when I started the mortgage industry, procuration fees didn't exist and brokers never charged fees. It was right at the end of endowments, but basically you got paid if you arranged a protection policy. So what you used to do is your mortgage was almost your door opener for discussing protection. That's obviously changed immensely. But I think the most successful advisors tend to be those who are able to discuss both things simultaneously from the start of the process onwards. However, that's not always realistic given what the sales process is and given how long things are. And that's why I sometimes think that an advisor, as you rightly say, can do rather well by mentioning it at the start and then effectively handing over the responsibility for that to a third party and saying, this is something I talked about at the beginning, we need to look at it. This is an idea of the kind of situation you ought to be in, but just park that there. Let's not have a long discussion about it because I'm going to get somebody else to talk to you about that later. Or I myself will come back to you and talk to you about it later. The other thing I think we've had, certainly, I think the credit crunch and certainly at the moment the issues in mortgage supply mean that advisors may be more reluctant to spend 2 hours having a long protection conversation with somebody who may end up failing to get a mortgage because their situation's a bit unusual, or may end up losing the house thereafter, or may end up being gazumped or unable to sell. So I can understand why it's split, but the most successful advisors we have who are good at selling protection themselves tend to be those who come from a generation where what you did on day one was talked about mortgage and protection, and those who stayed in hand all the way through the process. But yeah, we have it's a brave new world. And, you know, as you say, selling protection over the phone is one of the hardest things you can possibly do, I always think. Buying leads and selling protection over the phone, you know, I mean, you can't think of a much more ambitious way of learning a craft.
Hence why I'm out of it.
Yeah, absolutely. But I think, you know, again, it's let the specialists do the specialist thing. If you're lucky enough, or you work for a large enough firm or network or whatever, where they have got protection specialists, use them, because advisors are very bad at doing that, aren't they? They're very bad about saying, well, I'll let someone else do this bit, but I'm going to give away some of my commission. Well, actually, you're not. Certainly looking at our protection team, they tend to sell 5 times as many policies per customer as our advisors. Our advisors are a fraction of one, I should say. They're not arranging 5 times for everyone, but their hit rate, because they're going for much more sophisticated arrangements. You know, they're getting some IP, which is being linked in to a bit of family income benefit, which is being linked into a term policy, plus some critical illness as a standalone, plus some stuff through the person's business when they're self-employed. And, you know, realistically, the advisor may have that knowledge, but they probably don't have that time.
Agreed, without a shadow of a doubt. It's definitely, you know, if you're not writing any protection, 0% of 0 is 0. So it's much better to do a proper job, refer it out, keep the ownership of the client, and earn something for technically doing nothing. It's a no-brainer from that point of view. So what's I'm intrigued. What's the difference between running your mortgage network and your wealth network, or is it's a brokerage, isn't it? The wealth side, and your ER.
It's an AR firm. It's a brokerage. We did that very simply because at the time we wanted to have the support. So I mean, I suppose this is me preaching to myself about the converted. We wanted the support of a network. You know, it was a new venture. We realised there was liability, and we wanted somebody else to lean on for certain areas. There were also some things we weren't comfortable doing in-house. So DB transfers would be a good example. We had the qualifications, we had probably the knowledge, but what we didn't have was the experience. So what we'd rather do is hand off that responsibility, let somebody else take the responsibility for liability, to be honest, and we'd be happy to get a percentage of the fee. And then we do the ongoing management. So it's not very different. And again, it's a bit like equity release. I think the more holistic advice you can give, because if you think, so if we take, for example, one of your business owners, you know, you'll have a conversation with them about mortgages. That may then go into how they take their income. It may then also go into what they're contributing into their pension, because that may be one way they're reducing their personal income and corporation tax by chucking money into a pension. It then goes into a conversation about their protection. Who funds the protection? Is it the business? Is it them? It then goes into, well, if you've got a pension, are you putting in the right amount of money? And I think also it's ring fencing clients, because if you can look after all elements of their financial planning, in maybe combination with their accountant, then that's a really comfortable place to be, because historically mortgage advisors have done okay and have actually had a lot of business referred by IFAs, because IFAs haven't tended to dabble in the mortgage market. I suspect that may change. I think as we look to a more automated world where probably our vanilla and our pound for pound remos are often done online and possibly without broker interaction, in the same way, a lot of the wealth space is going to get automated. At the moment, I was chatting to someone the other day about pension transfers, and as a kind of a quick tot up, we thought anything under about 70,000 is not worth paying an advisor, because our fee will take a couple of years to pay back. And I've always thought in IFA world, I don't really want a client to come on board unless we're pretty confident we can add more value than we've charged them within a 12-month period. That seems to me to be a fair payback time. And on smaller funds now, because of the amount of complexity involved, it doesn't stack up. So I think the two come from a very similar place, and they're actually not that different, because a brokerage is a brokerage. So whether you're arranging protection or mortgages or pension advice, it should come back to the same thing. The big difference, and one thing I wish we could do better in the mortgage industry, is that it's an ongoing service for nearly everybody. And certainly we as a network have been involved in talking, certainly the later life space and the REO space, talking about can we change procuration fees, so rather than getting a massive lump as a one-hit wonder up front, actually we get something where we get trail, because then we can say to the customer, you're paying to have me on call as an advisor long term, use me. Right. And there's going to be, I'm sure both of us have been in the situation where a lender has written to an existing client and the existing client says, don't worry, I've sorted it out directly because I know how much hassle and work it is for you, so I thought that'd be easier. And obviously your reaction is generally not, oh, how wonderful. Yeah. But actually, if we got paid the equivalent of trail that the client was aware of and the lender was aware of, and the lender probably, helps us arrange, everyone's a winner, surely. The lender, gains back lots and lots of time. It's money they're having to pay out in-house anyway, and it means the client keeps advice. But I think one of the worries for me at the moment is the FCA seems to be worrying that, they're insistent under the mortgage market review to stick advice at the forefront and at the heart of mortgages is something now they're worrying is having a negative impact on the market and competition. And I think that's a disaster. I think advice is super important. I just think we need to change how it's paid for slightly. And, you've referred earlier to your mentor programs and the various coaching things you do. And I'm imagining most of them are on a subscription basis, because that's a very effective model for that kind of advice. Effectively, wealth traditionally is on a subscription basis. Possibly historically it wasn't disclosed because it was ongoing trail commission that sometimes clients didn't know about. But if we have a subscription basis, I was just having a look at my Fitness Pal, it may not look like it, but I quite like running. And, it's a subscription and you get a little note every month saying you've paid another $3.99. Are you happy with this subscription? How great if we could have that relationship with our mortgage clients, because actually that way they'd have access to advice. It needs to be costed out, and it might not be cost effective on very small loans, but on larger loans or on complex stuff, what a great way of doing things.
Yeah, that was immediately my thought when you said it. I do agree in terms of, and it gives more value to the business as well. From that point of view. It makes it much more valuable. But that was my immediate thought, was how my brain was ticking then, thinking, well, how would that work from a cash flow perspective, where, for example, advisors want to take protection on the drip and as a trail. But actually, there's that element of, but I need the cash to live at the moment. And if I'm getting it, it's going to be 6, 8, 12, 18 months before I'm actually earning big bucks. But I suppose if you worked it out right, small under a certain value was paid up front, a bit like you do with protection. I always talk about over £100, take it on the drip. Under £100, take it up front, and slowly but surely reduce your £100, 90, 80, 70 until it's all on the drip. Do you think there would be? Do you think it is something that would ever come in terms of mortgage procuration fees paid on the trail?
It's difficult to say. I mean, I think the obvious place to do it is probably the easiest place is probably Rio. Because at the moment, one of the big issues we've got, apart from this stupid affordability and death stress, which is basically, I think they got couple of days ago, someone saying RIOs have been a grotesque failure. Under 3,000 RIOs arranged, full stop, end of story, ever with any lender. I mean, it's ridiculous. But one of the factors we've got, and we know this, when we look at the big equity release brokerages, we know that there's a significant imbalance. If you phone up most of the big equity release brokerages, okay, and say, hi, I'm 60, I am still working, I want 30% LTV, what shall I do? You're very likely to walk out with an equity release mortgage, even though you probably could have got either a standard loan with a, perhaps a smaller building society or a RIO. And the reason is that you're getting 2.5% to 3% procuration fee here and 0.3 to 0.5 here. Now, I wonder with RIOs whether we could have a RIO where you pay a normal proc fee the same as you do in mainstream mortgage world, but then have the remainder of the differential between a equity release and a normal proc fee paid over the next few years. Because to my mind, that would be something the regulator would be fairly comfortable with, because RIOs should be reviewed, right? They are interest-only mortgages. You should be building something in. By the point you get to lifetime, you probably can't afford to do anything else. A RIO generally is a can kick. It's somebody saying, I thought I'd sell up and pay my mortgage off by now, or I thought things would work out differently. I've still got a mortgage. It's fairly small and I can afford it. But my existing lender is saying, sorry, matey, you're about to hit 65. We'd like our money back, please. We won't extend. So for those individuals, they should be having ongoing advice as when's the right time to sell? Should I pay a lump sum off? At what point are my investments getting to a point where my interest rate of my mortgage is higher than my return on my investments? Because obviously then I should be paying my mortgage off. So actually, I think that's a good place for it to start. And then we work it out from there. The problem in the UK, I think, mortgage market generally, is the margins are too tight. If you go to most of the countries, you won't be finding 5-year fixed rates at 1.3%, which is what you can do in the UK at the moment. And I think that's an inefficient market. We mentioned earlier, everyone's trying to lend to the same customer and they're fighting on rate. If we could get to organisations lending on criteria, Halifax used to be great at this, 1 year self-employed contractors, many more people have got into that market now. But if we could lend on criteria rather than just on rate, there'd be better products out there for the consumer and advisors would be being paid more because there'd be more kind of fat on the bone.
Yeah, I completely agree. It's a great idea. Do you think so? That's what do you think timescales would be before that's even considered?
I don't know. We proposed it with a couple of the big companies who are currently ER lenders moving into thing, and we sit in a couple of committees with them. So we're hopeful, but the mortgage market is extraordinarily slow to change. Compare what I was talking to my youngest, who was struggling with the idea that I didn't have an iPhone, whatever. When I was his age, and completely disregarded the concept of not being able to have the internet or emails. And in fact, even DVDs, which are now terribly old fashioned, they didn't exist either. And we were watching videos, which are kind of like museum pieces. So you look at how fast things like that have changed. Look at what we're doing now. We couldn't have done this a few years ago, not very many years ago at all, in fact. So, whereas mortgages are pretty much the same as they were when I started my career. Other than the fact I don't get a fax once a day telling me what the rates are. So there's so much room for change in the mortgage market. And there's some interesting people. We were talking recently to an organisation called M-Cube. Stuart there, we've been chatting to for a couple of years. They're trying to bring AI to underwriting. 48-hour offers is going to be their standard offering, and they'll offer a white label to lenders where they can run they can use their process and piggyback off their process. And a lot of it's really intelligent, clever stuff. If you give me your bank statement and I've got a bit of AI, I can absolutely work out how much money you should borrow within moments, within seconds. You might be someone who can borrow 10 times their income completely legitimately because you live the life of a monk. You may be someone who shouldn't really ever have a mortgage because whilst your salary is very high, you spend money like it's going out of fashion. Those are surely more intelligent decisions than saying everyone should borrow 4.5 times salary, or everyone should go through the same affordability calculator using ONS data, which is an average, so doesn't actually apply to anyone properly. It's we need to make changes. So yeah, I'm hopeful, but also world-weary and sceptical at the same time.
You've been in the industry to know that the examinations are still the same ones that I did in 2003.
Exactly.
It's good old change. So what's next then? Finishing up as we come to a close. What's kind of next for Rory over the next few years? Is it going to be another 5 businesses? And what's next for JLM?
We're pretty much where we wanted to be. I think we've relatively, we've grown kind of in line with the UK mortgage market. We originate about 1% of the mortgages in the UK, about. So I think the mortgage market this year is about 240 billion-ish, and we'll do less than 3, but more than 2.5. So, and that's been fairly consistent. As the market's grown, we've grown in tandem. So I don't think we want to necessarily become much larger. We will do kind of organically, I suppose. I think what we'd like to do, my ideal scenario in a kind of slightly evangelist way, Seb was called a mortgage evangelist a little while ago at something he was at. And I think to a certain extent, I think there's lots of things in this industry which I don't really like. I don't like the idea of how networks charge members. I don't like the idea of loaded life premiums. I don't like the lack of transparency. I don't like that mortgage advisors are held in less high regard than they should be, in my opinion. And I don't like the way in which advice is being cheapened. I think most advisors are absolutely invaluable. They're probably paid what the market recognises as being a high income for a very important service, but they're not regarded as such. So I think I'd like to get to a point where advice was more highly prized and advisors were more highly looked after. And it does frustrate me sometimes that we have lenders doing things like offering 90% direct but not via advisors, or dual pricing has been on and off the radar periodically. I think things like that cheapen what we do. And actually, I'm sure for many of your clients working for kind of the complex self-employed world wouldn't know what to do without you. I think it's perfectly legitimate saying that some people probably don't need an advisor. If I've got 100,000 mortgage and I want to get a new rate, do I need an advisor to do that for me? I should have the option to do that, but I maybe don't need one. But for most people, they're not in that boat. We very, very rarely arrange pound for pound remortgages. They tend to involve changes in term, changes in borrowing up and down, or general life advice. And I worry that lots and lots of consumers without advice will just take 5-year fixed rates because they look great and they're really cheap, and actually won't think about the fact that they're in a line of work where they'll probably need to move house in 2 years' time, or they're planning a family, or one of them's going to give up work. People don't tend to join those dots together where it's an advisor, that's all they do.
Yeah, without a doubt. Yeah, it's going to be interesting to see how things pan out, doesn't it? It sounds like I do agree with everything you've said there. I think one of the reasons why I love social media so much and I advocate and teach people how to use it so well is because I think the more content that we can put out, the more education that we can bring to the forefront actually raises the profile of the advisors and shows the expertise firsthand, which, I'm a big fan of. Kind of the whole reason for Pro is to help people build a more successful financial services business, but it's also to improve the lives of advisors and actually to raise the profile of the industry almost from the ground up is kind of the thought process that I have. So it's great to hear that we're on a similar page from that point of view.
Yeah.
So what's if anybody wants to reach out to you then, or talk more about becoming a JLM network member?
Absolutely. Always happy to talk to absolutely anybody. And as I said, I think whilst specific individuals and firms fit our model very well, I'm always very happy to give anyone a bit of advice. And if they want to phone me and have a chat and they don't fit our model, I'll tell them that, but I'll also tell them probably who to look at. So I'm quite agnostic, really, because I want people to join us and be happy and it to be the right fit for them. Absolutely. They're very welcome to Very. Shall I give out some contact info?
Yeah. Email address or LinkedIn is probably, I saw you're obviously on LinkedIn and stuff.
Yeah, so. Absolutely. So find me on LinkedIn. I'm normally the first Rory Joseph, excitingly enough, or JLM Mortgage Services, or just look at us on the web. Probably the easiest ones, jlmmortgages.co.uk. But yeah, always very happy. And I think whatever we can do for this industry to make it better and make consumers more aware of it, then, absolutely, you're right. Financial education is a really important job we've got. And it's people like you, Gary, with your social media work that, are helping push that forward. And that's a really good thing.
Yeah, and it's so refreshing to speak to you today and finally get this to happen and everything else.
Indeed.
Because the way your network works. Yeah, exactly. I'm a persistent bugger. Just correlating the diaries, isn't it? So lockdown's been a godsend from that point of view. It's made everyone's diaries a little bit easier to reach.
Absolutely.
It's a good one to see the difference that JLM has to the other networks that I've investigated and looked into. So hopefully from listening to this, there's going to be some people reaching out. But if this is your first time listening to the Financial Pro podcast, we're over 100 episodes now. We've been listened to more than 70,000 times in 70-odd thousand or 70-odd countries. And the whole ethos is just helping you to create leads, sales, profit and time, build a more successful financial services business. And I hope you've enjoyed today's episode with Rory. I always like to leave with one thought, which is when thinking about the brand Financial Pro, it came around because perseverance leads to results, which creates opportunity. What does pro mean to you, Rory?
That's a good note to finish on.
Doesn't have to be an acronym.
Thank goodness for that, because I'm not altogether sure I can put one. I mean, I think, pro is an expert, and experts actually have had a rather bad rap over the last couple of years. But I think, when you need something doing, if you can get someone who's a professional to do it, then generally speaking, it will do it well. And I think now we live in a world where people can share their experience much more easily, whether it's the Trustpilot of this world, social media, reviews, whatever. Actually, you find a pro, you check out their reviews, and if they're a pro and the reviews are good, then you should go for it.
Love it. Thank you very much indeed for giving us your time this morning. Really appreciate it. I've
absolutely enjoyed it.
So thanks very much, everybody. See you on the next episode of the Financial Pro podcast and live in the Financial Pro community.